Trend lines are one of the most powerful concepts in trading. We see this strategy being used by institutional traders, and their trend line-based strategies are often visible in charts. So, first of all, what is a trend line? A trend line is simply a line we draw using swing highs and swing lows in a trending market. For example, you can see here that the market is clearly in a downtrend. It moves down, then goes up again, followed by another move down, then up, and so on. Usually, in a downtrend, the market creates lower lows and lower highs as it moves forward in this pattern. Now, since this is a downtrend, we can draw the main trend line using the lower highs like this. Along with that, we can draw another supporting trend line below the candles using the lower lows like this. These two trend lines will help us understand the price movement and identify potential areas of resistance and support in the market. Now let's check an example of an uptrend. You can see here that the market is clearly in an uptrend. It goes up, then down again, followed by another rise and fall, and so on. Usually when the market is in an uptrend, it creates higher highs and higher lows as it moves forward in this pattern. Okay, now that we've identified the uptrend, we can draw the 333 trend line using the higher lows, like this. Additionally, we can draw another resistance trend line above the candles using the higher highs, like this. These two trend lines will help us understand the price movement and identify potential areas of support and resistance in the market. Now, let's understand why we draw trend lines. The first reason is that trend lines act as support and resistance. The upper trend line provides resistance, and the lower trend line provides support. However, we should not blindly make trades based on these alone. It's important to consider other factors before making any trading decisions. We will discuss all of these in this video. The second reason to use trend lines in trading is to identify potential reversals in the market. When a trend line is broken, it gives us an opportunity to consider a possible trend reversal. In a downtrend, we draw the trend line above the candles. If the price breaks this trend line, it suggests a potential reversal, indicating the price might start moving higher. Conversely, in an uptrend, we draw the trend line below the candles. If the price breaks this trend line, it signals a potential reversal, indicating that the price might start moving lower. To draw a trend line, it's essential to have at least two key points on the chart. Additionally, it's important to treat the trend line as a zone or area rather than a straight line, as prices often fluctuate around the trendline area. For example, in a downtrend, draw a trend line that touches some wicks and some bodies to maximize the number of key points touched. Remember to consider both the wicks and the main body of price movement at key points. I hope this concept is clear to you now. Now let's learn how to trade by combining price action. There are two main approaches to trading: trend trading and reversal trading. Let's start by understanding trend trading. In trend trading, we look for a specific setup where trendline support and resistance come together at one point. This point is called the area of high confluence, which is a place where different types of traders are willing to take trade positions. To understand this concept, imagine a market scenario where a support level that previously helped the price rise has now turned into a resistance level, preventing further upward movement. In this situation, different traders use various methods to make their trading decisions. Some traders focus on the resistance level, considering it a critical point. Others rely on trend lines to guide their trades by identifying patterns in price movement. Candlestick patterns are another tool used by traders to make decisions. For us, we prefer to trade based on the area of confluence. This means we look for a combination of factors, such as resistance levels, trend lines, and candlestick patterns, coming together at the same level. When multiple indicators align, it strengthens our confidence in making a trade decision at that particular level. Since various traders use different strategies at this level, it becomes an area of confluence, highlighting its significance in the market. As traders, let's break this down clearly. In the current market, we are experiencing a downtrend. As professional traders, it is essential to follow the trend. In this situation, we should look for opportunities to trade short positions. To do this, in this case, draw a mini trend line to refine your analysis. If the price breaks this mini trend line, it may be a signal to take a short position. While the overall trend is bearish, there may be a short-term bullish trend causing some concern. If the price breaks the mini trend line, it confirms that the short-term bullish trend has ended. At that point, the overall bearish trend resumes, and you can consider a short trade position. Let's consider another example. Follow the same steps as before, but this time, use multiple time frames. For instance, in the daily time frame, if the market is in a downtrend, draw a trend line by connecting key points. Identify a support level that, after a breakout, has turned into resistance. Additionally, the trend line and the support level are meeting each other, creating what is known as an area of confluence. Now the price has started to approach this level, and we don't know what will happen next. The bigger picture shows a downtrend, but the immediate short-term trend is bullish. First, we need to observe how the price reacts as it approaches this level. Currently, there is a hanging candle, which indicates uncertainty. However, even if the price reacts to this level, we shouldn't rush into trading immediately. Next, we need to draw a tight trend line similar to this one. But with this type of tight trend line, we may encounter fake breakouts. To handle this, we should examine the same chart in a lower time frame. On the left-hand side, we have the daily time frame, and on the right-hand side, we have the 4-hour time frame of the same chart. The resistance line shown here corresponds to the daily chart, and we can also see the same resistance level on the 4-hour chart. Similarly, the trend line visible on the daily time frame corresponds to the trend line on the 4-hour time frame. Trend line on the daily time frame aligns with the same mini trend line on the 4-hour time frame. If we look at the trend line in a bigger time frame, it appears imperfect. However, when we switch to a lower time frame, it appears more accurate and clear. This helps us identify trends more easily and reduces the chances of fake breakouts. Now we need to trade based on lower time frames. We observe that our mini trend line has been broken, and the price has also broken the previous low. This confirms that the short-term uptrend has ended. Currently, the overall market view is bearish, making it suitable for a short trade. However, it's important to note that the breakout of this mini trend line is not the only critical factor. What matters is that this breakout must be rejected after an area of confluence. Next, let's explore reversal trades. To execute reversal trades during a trend, we need to identify specific price action patterns. These patterns include the double top, double bottom, and trend-changing patterns. For example, if the market is in an uptrend, we draw a trend line below the candles like this. In an uptrend, forming higher highs is very important. However, in this case, the price has failed to make a higher high. At the resistance level, the price has formed a double top pattern. This is a sign of momentum loss and also a reversal pattern. Now, we need to wait for the trend line to break. If it breaks, we can take a short position. The same method can also be applied to a double bottom pattern. Now, let's understand how trends change. Currently, the market is in an uptrend because it is forming higher highs and higher lows while moving forward. We have drawn a main trend line below the candles. However, we notice that the price failed to make a higher high and instead made a lower high, indicating a loss of momentum. In an uptrend, if the price makes a lower high, it could signal a potential trend reversal. Once we observe these patterns, we should wait for a breakout to occur. If the price breaks below the trend line, it suggests the market might enter a downtrend, allowing us to take a short trade position. Thank you for watching. We hope you found this video helpful and learned something new.